Welcome back. You're watching Stock Watch with me, Zinati Kuma, and joining me to unpack your stock-related questions tonight are Shane Watkins from All Weather Capital and Grant Nader from Benguela Global Fund Managers. Please be sure to send your questions via email to stockwatch@bdtv.co.za or via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. Thank you so much for your time, gents. Of course, we have to start off with the big news of the day. Something that I would figure picked up the Resources 10 complex today in a day that had red trading across the board. I want to start off with you, Shane. Lots of questions flooding in for that potential deal. What does this mean for Anglo American Platinum and Kumba Iron Ore, this offer that BHP has put in for Anglo American? Because they also talk about a demerger of Anglo American from Kumba and Amplats. Shane?
So, Zanati, the proposal from BHP is essentially that prior to them acquiring Anglos, these shares would be unbundled to their shareholders. Now, I think we must emphasize that in the first instance, this is an initial proposal from BHP. There's no firm intention. And it also does not exclude someone else coming in and making an alternative proposal, which may include Kumba and Amplats. But in any event, this specific proposal is that Kumba and Amplats would be unbundled to their shareholders, and then the residual, the core of Anglo American, if you like, would then be acquired by BHP. This has created an impression that there will be a significant overhang of Kumba and Amplats shares, and Amplats was down, let's say 10, and Kumba was down 5, because people have the impression that there will be a surplus of these shares which will not be taken up by international shareholders. There are a couple of factors here, including the fact that to do this would be quite onerous on the country's foreign reserves. About 200 billion rands worth of shares would be sold by foreigners because, as you know, Kumba and Amplats are not listed offshore. So offshore shareholders wouldn't want to own these shares that are only listed on the JSE. And so these shares would then be sold on the JSE, and about 200 billion rand would have to be turned into dollars and shipped offshore. So that would require Reserve Bank approval, and I think it's one of the issues with the structure of the current transaction.
So wait, that means that then BHP wouldn't be taking Amplats and Kumba with, Shane?
No, BHP they clearly have no interest in South African assets, and they have no interest in platinum or in South African iron ore, let's say. Essentially, if you want to understand this transaction, you've got to understand that what they're really after is the 550,000 tons per annum of copper that Anglo American have in South America. That is the main reason for this deal. Everything else is kind of peripheral and secondary. And so, Anglo American has a number of other assets, but the most valuable asset is copper. And as you know, from the emergence of EVs and increased electrification of our economy, copper is trading at all-time highs, and this is the most highly rated asset in most commodity companies' portfolios, and this is really what BHP want. And the reason that they want this is because it's taken Anglo American nearly 10 years to develop these assets in South America, and it's much easier to buy than to build yourself. If you build yourself, you've got ESG issues, you've got water issues, you've got power issues, you've got permitting issues, and then you've got project execution risk. These are almost multi-decade projects, often in difficult geographies with no roads and transport infrastructure. You often have to bring in your own power infrastructure. So it's cheaper to go and buy someone else's asset that's already been developed than to build your own.
Yeah. Of course, now people zooming in on Amplats specifically because, I mean, we know the headwinds of the PGM sector there. But, I mean, people have constantly been picking Amplats because it is a good company. There's a question here. Last week, I looked like a rock star with Amplats going up 5% from my initial position. It's 20% of my portfolio. I know that you would have spoken at length by now about the news, but what about Amplats investors? After today's disaster, I'm down 28%. What do I do, Grant? That is the big question.
So I think there's a few market dynamics at play here. So if these shares are unbundled, as Shane said, there are going to be a lot of forced sellers, these foreigners that are going to be exiting a large number of Amplats and Kumba shares, one, because they don't want individual name companies. Sometimes companies only want to own a diversified miner. Now you're going to be holding a platinum company and an iron ore company. So that'll be locals as well, potentially. So that's selling. And also there's a significant influx of shares into hands that may or may not want it. You'll see short sellers will jump onto that opportunity as well, knowing that there's going to be selling pressure for some time. So it's less about the fundamentals with what's happening. If you saw the price pressure on Amplats, and I think more about this dynamic and this mechanism in which the shares, this takeout offer has been made. So I don't think it's a reflection of a sudden change in fortune for Amplats. I think it's, but I don't know how long it is till this washes through the system. If this deal goes ahead, that overhang will be in the market for quite some time, I would imagine, until it's approved and until it's actually effected as well. So yeah, I think you're going to have to sit tight on that one, or just take the losses and move on. Can't really offer.
But I mean, let's be clear. I mean, the deal, there's not even a firm transaction on the table yet.
Exactly. Yes.
So BHP have got 30 days to kind of, in the UK they say put up or shut up. And so, we'll know in 30 days whether there actually is a transaction from them in the first instance. And in the second instance, as I said, another party may come in with a deal with an alternative structure that doesn't involve the unbundling of Amplats and Kumba. And even were this current transaction to proceed, it will probably be at least 12 months before the transaction is effective and those shares are unbundled. So, perhaps the move in Amplats today was, let's say, excessive. But I mean, let's be clear. The current transaction, as it's proposed, will definitely not go ahead, right? I mean, the shares are really trading 5 or 10% above what BHP have offered. So what you can say for sure is the current transaction, as it's proposed, won't proceed. Either BHP will increase the offer or make a different proposal, or another party will come in. But what is currently proposed will definitely not happen.
Ooh, very, very interesting insights there. Of course, this is one that we will be closely watching until that date. What's it, the 22nd of May? Let's go into more questions from the viewers, even though I think we'd all be fine talking about BHP and Anglo today. There is a question here on Sasol. Is it value or a value trap? Grant?
So I think personally, I think it is a value trap unless something external drives some kind of value unlock, being predominantly the oil price and or chemical prices or both. But I think there's nothing that they seem to be able to do or are willing to do or are able to do that is within their control in terms of their operations and their fundamentals of their business that is going to unlock value. It's going to have to come from an external driver. So if you have quite a nice or firm view on those external factors, chemicals prices, economic pickup will drive that, or the oil price outlook, I think, Sasol could prove to be a value trap. That's just my personal opinion on the stock.
Yeah, quite a polarizing stock. Shane, on your side, value or value trap?
So Sasol should be doing well in this environment, right? I mean, the oil price is nearly $90. The rand is well above 19. Chemical prices have recovered 15% over the last 12 months. They should be doing well. Why are they not doing well? Well, I guess there are two main reasons. In the first instance, they don't have a management team that really care about shareholder value. And let's be dead honest, they're not also exactly that energetic or competent. We've had a number of missteps at Sasol over the years. And so you've got at best, an average management team that doesn't have shareholder interests at heart. And then the second thing that has driven selling in Sasol, which is the reason the share price is down, is there was a change in the South African pension fund regulation called Reg 28, which allowed South African pension funds to move from 30% offshore assets to 45%. And in that move, in order to free up money to take it offshore, rational fund managers looked at their portfolio and said, well, is Sasol the best oil company in the world? And as I've said, not even close. So they've sold Sasol in order to buy better quality oil companies offshore. So to some degree, Sasol has become a bit of an orphan asset. And because of let's say, a management team that lacks imagination, there's no obvious catalyst to unlock the value. I mean, the share's on a P of 3 or 4. They could easily sell Lake Charles in the United States, which is probably worth, I don't know, I'm guessing 70–80% of their market cap, sell that for cash and buy back their own shares on a 3 PE. But because they're not aligned with shareholders and they manage the company in an unimaginative and bureaucratic way, they are not taking any steps to unlock shareholder value.
Very, very interesting insights there. Just going back to PGMs, there's a question here. Your view on Amplats going forward. It has run 20% in 2 weeks. Is it worth buying the stock at these levels? Of course, we have seen a dip today. I don't know if it was caught up in the whole Amplats situation. Grant, Amplats at this point?
In our view, it's not necessarily the highest quality of the platinum miners, but I think if you are bullish on the outlook for PGMs, even if it's shorter term, we all know there's a lot of long-term structural headwinds that they're facing, but perhaps the prices have found a bottom in the short or medium term, and there's some opportunity there. Amplats should give you quite a considerable gearing to that PGM price upside as well. So as far as all of those stocks are in the space, you're going to have gearing to the PGM price. And again, it's a function of what your outlook of those commodities are. And in that case, I think Amplats will prove to be perhaps not the best quality, but as good a miner or as good a way to play that as the others would be. So be clear on what you're doing and why you're doing it, and then you can play in the PGM space. But it's not a long-term, I don't think there's a fundamental long-term buy and hold story there at all.
Yeah. Shane, on your side, Amplats, particularly maybe in relation to the kind of risk that exists now with a potential deal on Amplats?
So I would say that if you have to compare the asset quality, I would say Amplats has got significantly better asset quality. Their main asset is a mine called Mogalakwena, and this is an open cast mine with very high grade ore. It's just a better quality operation than Amplats' underground operations. And you know, you can buy Amplats 12% cheaper today than what you could yesterday. And so what we've been doing today is switching out of some of the other PGM companies into Amplats, because the selling in Amplats is not to do with operational problems at Amplats, it's to do with the technical structure of this transaction.
Yeah. All right. There is a question here on Dis-Chem and Clicks. Of course, you know that Clicks came out with interim results today. It's a kind of Dis-Chem versus Clicks question. Your view, Dis-Chem at circa 10 times PE, Clicks at circa 23 times PE. Is Dis-Chem a buy and Clicks a hold or sell? They have similar business models, but the market seems to have punished Dis-Chem. Why is Dis-Chem relatively so cheap and being punished? Am I missing something? Let's start off with you, Grant. Dis-Chem versus Clicks. And which one would you be holding, selling, or buying?
So I think just to start, I don't think Dis-Chem's at a 10 PE at all. I think we can just double check on that. But let's just talk about the companies themselves. I think of the two, for me, Clicks is a better quality operator. So they have a much more efficient operation. They deliver much more sort of, they run the business a much tighter ship, and they're giving you much higher quality returns over a long period of time. So in terms of put under the drawer and forget about it, just buy and hold, Clicks is that kind of business. Dis-Chem, I think, is moving closer to that direction. I think Dis-Chem has a little more of that sort of self-help opportunity, because I think there's more inefficiencies in Dis-Chem, and there are more areas for improvement that can drive those returns toward where Clicks is operating. So I put it this, I think I'm kind of sitting on the fence. I like them both. I think Clicks is already where Dis-Chem is trying to get to. And if Dis-Chem can ultimately go there, they are trying to rationalize their asset base, etc. I think the new management is doing a good job. So I like what Dis-Chem is doing. And I think, I think that will also prove to be quite a good investment. I don't think it's materially cheaper than Clicks. I don't have the numbers offhand. We can just check on that. So of the two, I'd probably lean toward Clicks, but I don't think Dis-Chem's a bad option either.
Yeah. I mean, really, also the question here seems to be, is the market actually responding in an appropriate way to Dis-Chem? Shane, your thoughts on Dis-Chem and Clicks, and if the markets have it right or not?
So Zanotti, Grant's correct. Clicks is on sort of a 23 PE and Dis-Chem's on like a 20. So there isn't such a large difference in the rating. They're slightly different businesses. Clicks is more of a sort of a 750 square meter convenience format. Dis-Chem is sort of 1,500 to 2,500 square meters destination shop. So they're not directly comparable. The beauty of Clicks is it's a simple model, extremely well executed, and the company is doing a share buyback. So if you want to say what is your safe harbor in the retail sector generally, and in relation to these two companies, I think I would prefer Clicks.
All right. Well, let's get to more viewer questions. There's actually a question here on Aspen and Netcare. Aspen up 50%. Oh, so the viewer is up 50% on Aspen and down 50% on Netcare. What should I do, Grant? So 50% up on Aspen, 50% down on Netcare.
It is a tricky one. They are really, I know they're both in healthcare, but it's two entirely different businesses. The hospitals have such large challenges around, growing patient numbers, around medical aid, keeping pressure on prices. They've got a lot of internal cost inflation. They're struggling to pass on the prices. The medical aids are pressuring them. There's regulatory risk. So I don't see how the hospital groups drive any value realization through any of the hospital groups over the next 3 to 5 years. And so, yes, it's a significantly cheaper than Aspen, but I don't see the opportunity there to unlock that value. So I prefer to stay away from Netcare altogether, to be honest. And then as regards Aspen, it has done a lot, but I think they have, again, in this difficult economy, you want companies that can unlock value somehow. Aspen is doing quite a lot toward increasing the utilization of their manufacturing capacity. It's going to improve margins, it's going to improve cash flow, and improve their return on invested capital. So I like what they're doing, and I like the strategy they're trying to execute. So I think that's still a better prospect for growth and for opportunity to drive some value there. So of the two, I know it's more expensive and it has done well. I would still tend to stay with Aspen.
Yeah, I guess then it explains why the viewers up 50% on Aspen and why they're down 50% on Netcare. Shane, what would you do at this point if you were the viewer?
So hospitals obviously are in a difficult space, especially because of the kind of the talk around NHI, and NHI it relates a little bit to electioneering by the ANC, because I think it's unlikely ever to be rolled out simply just because the maths doesn't work on it. But there's going to be a lot of noise leading up to the elections on the 29th, and that's not going to be good for hospital groups, or for that matter for companies like Discovery. But I think they are starting to look pretty cheap now. I mean, they've never been this cheap. They're on 10 PE or less, and both Life Healthcare and Netcare have got quite strong balance sheets. And if they can execute decently and do a share buyback or something that's a shareholder-friendly action like that, then I think there's probably some upside. On Aspen, so as Grant said, Aspen have two manufacturing facilities, one in Port Elizabeth and one in France. And these facilities are running at about, between 40 and 60% capacity utilization. Aspen have said that they're going to announce some big transactions where some multinationals are going to give them some, what they call filling of steriles. Some of these products will be related to the obesity drugs, the GLP-1 drugs that have been rolled out. If and when Aspen do that, then they will deliver on a promise they've made, but they haven't yet done this. And Aspen has tended to be a company that overpromises and underdelivers. Of course, this time could be different, and they may well announce these capacity-filling projects with large multinationals.
All right. Well, let's get into another versus question. WeBuyCars versus Motus. Now that WeBuyCars are on the JSE, most investors say it is a good buy at about 20 Rand per share. Motus, on the other hand, is quite diversified and pays good dividends twice a year. Which one would be the best in a portfolio? Is there a place for both of them? I mean, can you even compare them, Grant?
Well, yes and no, because they have different business models, but ultimately they're still selling cars. Motus obviously sells a lot more new vehicles in their mix, and WeBuyCars is used cars, but it's an online portal. They've seen some really interesting and quite powerful growth figures over the past 5 or 10 years. So I think they've got a better growth story. They've got a better, clear path to driving the business forward. Motus at this point in time is quite constrained by the economic environment, by the inflationary forces and the interest rate environment, etc. And there's only so much they can do. They're doing a very good job with what they can control, managing their cash flow well, their assets well, but their hands are somewhat tied behind their back. I think WeBuyCars has a bit more of some kind of growth strategy that is in their control to some extent, because there's a large market from which they can take market share and drive future growth. So I quite like the story in the current environment. If things don't improve, I think, notwithstanding the valuation, because Motus offers a serious amount of value, WeBuyCars probably has better prospects over the next 12 to 18 months from a growth point of view.
All right. Pros for each. Shane, which direction would you be going in at the moment between Motus and WeBuyCars?
So Zanati, WeBuyCars is kind of more of like a financing business, because they go and they borrow money at wholesale rates from the bank. You want to sell your car, they pay you, and then they on-sell it at a lowish margin into the dealer network generally. So, they're entirely dependent on banks funding them. So they're more of like a financing transaction than a pure retailer. Motus, on the other hand, they've been selling Korean brands in South Africa for quite a long time, and two things have hurt them recently. One, just in the economic downturn, people are buying fewer cars, and secondly, they've been severely impacted by cheaper Chinese imports, and so it's just become a more competitive environment for them. I think Motus does look quite cheap, and what's carrying them at the moment is their parts business. As you know, whenever you take your car for a service, you're appalled by what the parts cost, and their large installed base of cars is at the present moment supported by the parts business, even though they're not selling a lot of new cars.
All right, I hear you on that. Well, gents, let us get to your stock picks for today. Grant, what are you picking?
So I'm picking Meta. They had results last night that were fairly solid, but they've ramped up their capex on AI. The market didn't like that. It's down somewhere between 12 and 15%. I think it's an opportunity for a long-term investor to tap into this one. They're very well positioned to capitalize on the trend toward advertising revenue growth, the potential ban of TikTok. The harnessing of AI is quite evident in terms of how they've driven their revenue growth and the opportunity set, and they're investing for that future growth. So I still think the fundamentals, the franchise is very strong, the fundamentals are intact, and I think it's a good opportunity for a long-term investor.
There must be something there, because you are the second person to choose that stock today. Shane, on your side, what are you picking?
So Zanati, I'm picking Remgro. Now, Remgro is almost the opposite of Meta. It's utterly lacking in excitement and growth, but it's extremely cheap. Essentially, Remgro has assets worth about 250 Rand, and the shares trading at 120 Rand. And they have decent quality assets. I mean, their main assets are Mediclinic, CIVH, which is a fiber business, Outsurance, Heineken, First Rand, a stake in Discovery. But essentially, you're paying 5 Rand for a 10 Rand note. But what you are relying on is the management of Remgro to do something slightly more interesting and exciting with the portfolio. For 10 years, Remgro has underperformed. And, we really are hoping that there will be some changes at Remgro. What they essentially need to do is they need to do a share buyback. They need to sell off their listed assets and do a share buyback. I mean, this is not hard to do, and it can be done with a stroke of a pen. And we need them to kind of grasp the nettle, realize that it's been a decade of value destruction, and it's about time for them to do some basic things, mainly a share buyback.
All right. Well, thank you so much for your time and for your analysis today, gents. Really appreciate it. That is all for tonight's Stock Watch. Thanks to our guests, Shane Watkins from All Weather Capital and Grant Nader from Benguela Global Fund Managers. Up next, The Close. Stay with us.